Want to take a look at the stock market today, specifically SPY ETF. Also want to transition into TLT ETF, which a lot of you I know follow me because of my trades with TLT ETF. Now, of course, I did get out of my TLT ETF just a couple weeks ago when we had the big bond market glitch. What is going to happen to this economy moving forward? My thesis, of course, has shifted considerably. And a lot of my content that I'm going to be talking about with regard to the stock market today, which of course is moving a bit higher, is all geared on this big shift. And I think one of the most important things that needs to happen is individuals need to break down where we are from the big picture, looking backwards. The Treasury market, the United States Federal Treasury market, is the bedrock foundation of the financial system worldwide. That is shifting significantly. And this is something that I think everybody needs to encapsulate when they're putting together any kind of analysis and how this shift is going to occur. I don't see overall growth for the U.S. economy moving forward like it has been. And I believe we'll probably see PE ratios declining significantly, maybe down to say 17.5 to 22.5 versus I think it's pushing 28 right now. I also we'll likely see more corrections in the stock market and the bond market. Interest rates, I expect will move higher over a longer period of time. That the golden era of America is basically done with. That there are now walls that will prevent the growth rates that we've had from continuing. One of the most important things is to take a historical breakdown of where we are, and I'm doing that in this video, breaking down, looking at debt. Now, the United States federal government lives well beyond its means. And I've broken down a lot of charts to give you a perspective as to what the Treasury market is all about, the debt that we have, who's paying for it, how that's going to shift, and what that means for interest rates and overall growth rates for the United States of America moving forward. So I'm going to take a historical look, and if you break this down, if you look at all these little charts I have and you look at the bigger picture, you'll get a pretty good understanding. Now, the stock market today is moving a bit higher. We got GDP numbers yesterday that are misleading. If you take a look at imports, what they do with GDP, I just want to briefly cover this so you get an idea as to what's going to happen there. GDP, when we import stuff, we didn't manufacture those goods, so they subtract imports from overall GDP. Well, there was a big surge in imports, which made it look like we had a decline. Okay, what happens next? We have walls up all around this country. Tariffs. We're not going to be importing nearly as much goods into the country. Because of that, we will see an appreciative decline in imports, which would make it look artificially that the U.S. economy surges in Q2, whereas someone won't take claim for the fact that a bunch of importers hurried up and imported a whole bunch, which brought the overall GDP number downward. This same individual will certainly take credit once the imports drop considerably and it looks like the GDP moves higher. So those whole data points are going to be skewed considerably. This is such an important point to understand. We are no longer steady as we go. That has abruptly changed. The economy will abruptly change immediately. We already know that ships coming to the United States of America are no longer going to be coming to America. We've lost like 58,000 container ships here in the United States. Fine. How does that play out in the stock market? Most importantly, all those importers, they were holding US dollars. they would repatriate some, they would buy US Treasury debt with others. Those dollars no longer exist. That simply put, importers or exporters to the United States are no longer sitting on an abundance of dollars. They are effectively moving money elsewhere, and that's where things get interesting. Let's jump in. First off, we're seeing this big transition. I'm trying to get as much content out as I can because things are all going to be significantly different. My numbers are skyrocketing. Thanks so much for subscribing and following along. Buttons are all over the place. This is a look at the Dow Jones Industrial Average since 1980. And now I have the same exact chart in a inflation adjusted. It's the same, but just not nearly as dramatic. Nonetheless, if you look at the numbers from 1980 onward, 1980's numbers are significantly lower. You would see this chart sort of do this, but still, it is upward across the board relative to today's numbers. Given that, I think we've seen the high for a long time. Then we are seeing some movements in the stock market today, but that is temporary, and I think we get unemployment tomorrow, and I think that's going to be the last decent number, if it is decent. All right, so this is where we're looking at how did we get here. We lived well beyond our means. Number one, the federal government has continually spent and spent and spent, but when you look at the numbers, and I'm going to break this down for you, when you look at these numbers and break down how everything is playing out, you can see that, yeah, the federal government, they're based on GDP, the numbers aren't really that bad expenditures-wise. Unfortunately, what happens is the federal government continues to take in less and less and less money, which increases on a percentage basis the deficit. And our debt looks horrific. I'm breaking all these charts down into individual presidencies, eras, if we would. Now, the president themselves does not necessarily have a whole lot of power over top, wield a whole lot of power over top of the economy itself. They can't necessarily propel it too far forward. But as we're finding out, a president does have the capability, probably not lawfully, of derailing an economy. All right, so we're looking here at the US 30-year Treasury yield. And this is such an important data point because these are our long-term interest rates. And as you can see, just stepping back, you can see long-term interest rates have consistently moved lower and lower and lower. Of course, we were hit with inflation because of COVID, and there's been a shift there. Here's the thing with long-term interest rates. I don't know how we go back downward. And it's simply a matter of supply, demand. There's going to be a lot more supply. There's going to be a lot less demand. All right, total debt. And as you can see, I mean, it's been consistently moving higher and higher and higher. We've had events. Bush Jr., of course, created two wars. Obama, and then a financial crisis as he was walking out the door, which Obama inherited. And this number itself is slightly misleading when you kind of look at things from a non-inflation adjusted basis and what's really going on there. Trump, of course, had a pretty decent economy that he inherited, didn't have to do anything. Unfortunately, of course, he got hit with COVID as he was walking out the door. And then debt to GDP ratios soared, of course. Biden took over from that, and we got to a point where we were flatlining. We're looking at debt to GDP ratios of about, 122%. All right. And here's your debt to GDP ratio. A lot of what we see, okay, you can see World War II all the way back. All right. And Reagan was the one who really kind of said, let's just go for it. All right. And he went for it 2 times with 2 tax cuts. And the idea was all these wealthy people are going to get tax cuts. They're going to spend their brains out, and the economy is going to explode so much that the federal government will take in more taxes, and therefore it balances everything out. The debt to GDP ratio kind of started moving higher and higher because of that. Clinton, as you can see, had he cheated. He had a good economy, and he also shrank the budget somewhat, and that's cheating. And because of that, there was a period where things went downward. Biden had a little bit of a downward, but it was really more of the shock to the system entirely and then the rebound of the shock. But Biden's sort of bump there, if you will, and then the opposite for Trump. Those were, COVID. All right, spending to GDP percentage basis. Honestly, it doesn't really move that much. The budget itself, based on what the economy produces, is fairly consistent. Now, after World War II, you could see the big spike in World War II. Throughout the late 40s, 50s, and into the 60s and 70s, we saw progressively higher spending to GDP ratio. This in itself is fairly consistent. The federal government doesn't really step out of line too much with, let's just spend beyond our means incredibly. Bush Jr., of course, the financial crisis, we saw the Great Recession. So GDP pulled downward significantly, but spending didn't shift, and therefore the ratio exploded. Trump, again, same exact thing, that the economy itself plummeted, but spending did not, and because of that, the ratio was skewed. And since then, we've been kind of moving backwards to normalization. Now, here's a number when it comes to spending versus GDP ratios. We hear a lot about they're trying to chop the federal employee workforce, all right, because that will save us so much money. Reagan was the one who really kind of pushed things. But if you look backwards all the way into the 60s, of course, you have a big shift there. But in the more modern era from the 80s forward, it was Reagan that really pushed total employees numbers much higher. Truth is, we're, 3 million? If we saw 10% get chopped off, that kind of gets us to a modest number. I don't see it. The total federal employees numbers themselves isn't the issue at all. What we spend things on, Medicare and defense, there's where the real problems are because, and if you are looking for fraud in any way, that might be the best place to look. But the federal employee workforce isn't really the issue. Budget deficit as a percentage of GDP. This is one of the things that I saw that is so, kind of where things are. Reagan, now this is kind of inverted. So Clinton, you can see that big move higher. He actually went above zero, which means Clinton didn't have a budget deficit. He had a negative deficit, if you will. Looking at this chart, kind of giving it in perspective. Reagan, of course, what was the one thing he did? 2 tax cuts and two tax reforms. And because of that, the budget deficits widened, which means the number went downward. All right. Bush Sr. kind of fixed some things. Clinton, of course, had the dot-com era where there was an explosion of investment and growth here in the United States of America and an astoundingly high-producing economy. Again, he totally cheated. This is really the only other time in our history when we had an economy sort of like that. Bush Jr., he had to finance 2 wars. He inherited the dot-com bust. Actually, I think it happened on his watch. But it was really, neither Clinton nor Bush Jr. really had anything to do with the actual .com, that was just technology moving forward at the speed of technology at that moment. Bush Jr., of course, would hand to Obama, and at that bottom right there is the exact moment when Obama kind of took over, the percentage of GDP on a budget deficit, the actual bottom, the Great Recession, the financial crisis. That then when the GDP recovered, you can see where it moved upward, but then Trump did his tax cuts, and look what happened there. Now again, COVID was immediately thereafter. So this is really kind of the thing that every time we see these tax reforms, the budget itself, as the chart I just showed you previously, doesn't change much on a percentage basis for the GDP. The only thing that actually does change is the amount of, on a percentage basis, taxes. And this pushes the deficit further. And here's the thing. I don't care. You want to give billionaires tax credits? Super. Awesome. One day maybe I'll be a billionaire and I'll take advantage of that. The problem is when you tell me, oh, it's going to trickle down to your pockets. Have you seen the frickin' debt? You can stop with that nonsense right now. Number one. Number two, if you want to give these people tax cuts, great. You also need to lower the budget. You're bringing in less money, plain and simple. So spend less money. But they're not. And that's where I have the problem, especially when they sit there and tell me, oh, but we're all going to be so rich. We're buried in debt to the tune of 122% GDP. None of us are rich. There's a couple, a handful. Here's a look at some of the tax reforms. You start with the Economic Recovery Act 1981. You could see the drop off in the tax rates, and that's when Reagan's numbers, the deficit to GDP went higher. In 86, Reagan did it again. Clinton kind of pushed things a little bit higher. We've seen some shuffling of this. It all boils down to this one thing. The government spends at a consistent rate on a percentage basis relative to GDP, number one. Number two, they continue to take in less and less on a relative basis, and because of that, our debt goes higher and higher. That is one of the key things. Here is moving forward, a second bullet point in that segment. The federal government wants to expand the budget even more. And they also want to lower taxes for certain brackets even more. Do you see where that's going? You want to raise the budget, great. You want to lower taxes simultaneously, we see historically what happens. And those are data points. That's not a political position. That's a data point. We're at 122%. At what point do we go BK? That's my take on this. So, looking forward, this is your foundation. Hey, we got a lot of debt coming in. We're going to have less and less on a percentage basis tax coming in. What does that do to interest rates? Number one. Number two, who buys that? And this is where things start to get a little anxious. Here's our trade deficit. There's an interesting thing relative to the trade deficit, and I'm going to pull up another chart here. The national debt. If you flip-flopped either one of these, you notice that there's a pretty decent correlation. What's happened is most favored nation, China, officially became law summer 2000 with Clinton. He finally officially penned it into law. Previous to that, it was more like, hey, we're going to treat you a certain way. And effectively, this removed all trade barriers. And for anybody I'm just celebrated my birthday 2 weeks ago, week and a half ago, of my age, Gen X, I remember the 80s, I remember the 70s, the 90s. Everything shifted to China. And some say that's a bad thing. Let's break that down because that's where things are not necessarily good or bad. And this is really where you need to kind of focus on when you're looking forward as to what's going to happen next. Take a look at the trade deficit. Let's go backwards on this chart. From 1990s, late 1990s, when China became most favored nation status, all right, we had an explosion of trade deficit. And this is such an important bullet point you need to kind of encapsulate in your analysis. When importers here in the United States buy all these products from China, Nike, we'll just throw them under the bus. Why not? All manufacturing goes to China. Nike is nothing more than a label here in the United States, and other countries produce these products and Americans buy it and they get their little swoosh for $350. Because the Bank of China has control over all this money, what they did was they didn't allow individual banks or investors or anything for that matter to shift dollars out. Instead, the Bank of China took those dollars. They didn't repatriate all of them. They invested some, but they bought US Treasuries en masse, huge amounts. All right, they peaked out, I think, at 1.2 trillion. They're down to about 750 billion at this point. And I've got a chart for that. All the debt that the federal government continues to produce, and all through the 90s and early 2000s, that was the big thing. And you'd hear it all the time. China is a currency manipulator. Then all of a sudden, Congress would shut up real fast because they would investigate and realize, hey, if we shut these people down, who's going to buy our debt? We're living well beyond our means. Here's a customer who's buying our debt. So you have this artificial investor that's doing two things. Number one, they're not selling those dollars and buying back Chinese yuan, which would rebalance the currency, which could potentially rebalance the trade deficit. That was not happening. Instead, China was buying this treasury debt, which would push price up and keep interest rates significantly lower. I've showed you those charts. What just happened? We have effectively solved the trade deficit. So our best customer effectively was just snubbed, and they will no longer be getting excessive amounts of US dollars. Because that's happening, they have no incentive to buy US treasuries. In fact, China has been buying tons of gold. Have you seen the price of gold? A lot of that is China rebalancing their own reserves, and they're moving into other currencies. That is softening the US dollar consistently as well. Simultaneously, what is the Republican Party doing? They want to increase defense spending by $150 billion. They want to slash everything they can, anywhere they can, but there's a lot of pushback, and a lot of members of Congress are like, yeah, I'm not so sure about that one. They also want to lower taxes for certain brackets that, let's be honest, none of us are in, so why would we ever defend it? Doesn't affect me. As a matter of fact, every proposal I've seen, my taxes in these brackets goes higher. So does yours. So we're going to see a much larger deficit with a higher budget and lower taxes. But we're also going to see our biggest customer no longer buying our debt. What does that do to our interest rates? What does that do to the economy? When you start kind of pulling back a little bit, we are probably going to see, we are a frog in boiling water where every once in a while the heat gets cranked up. Just think that through for a second. This, back to the national debt, on a percentage basis for GDP, I think we easily clear 150. For a second reason, Not only all the things I've mentioned, but also this economy is about to shut down. All those shipping containers, I've been doing my notes on Substack, as well as I've been trying to get into Blue Sky. I can't get into my X account. I keep saying, hey, listen, let me reset this, and I just can't get in, so done with that. We are seeing this shift I think we would normally get 120,000 shipping containers coming in. We just saw a 58,000 shipping container drop off when they start arriving or not arriving next week, and a bit more the week after. That represents 700,000 transactions inside the United States that simply just evaporated. From that, oil, have you seen the price of oil? I was short oil. I just got out this morning. I was actually long SPY ETF calls. Doubled my money. Small position, took the money and ran. Overnight, it really skyrocketed and I got out and didn't get out of my high. This is the first wave. Second, other countries have put tariffs on the United States. Boeing is just getting slapped left and right. China's like, yeah, we don't want any Boeing aircraft. We're not accepting anything. Have a nice day. So there will be not just tiny ripple effects, massive shifts that foreign investors or foreign companies are not purchasing American goods at the same pace. Revenues will decline sharply. Activity within the United States of America, that activity will decline sharply. And then it's just going to keep going. At the same time, the deficit will expand more. Every time the Congress lowers taxes for the wealthy, the government brings in less tax revenue. It's interesting how that works. You lower taxes, less revenue comes in. But then there's supposed to be this explosion of growth. We are going to see a shutdown in growth. Not because of what we saw in GDP yesterday, obviously. Moving forward, US 10-year Treasury yield, there's no way it stays below 5. Starts to trickle higher over the course of many months, a couple years, decades. 10%? Sure, eventually. I don't know that we will get to that point by the end of Trump's term. I think instead what will happen is there's no historical data that allows for the House of Representatives to remain Republican midterm, especially with Trump's approval rate levels as low as they are. So more likely than not, we will see a flip of at the very least, a flip of the House. And then all of a sudden, there's some kind of balance there, a check or a balance. Let's see how that happens. And policy shifts themselves, like the tariffs themselves, likely unconstitutional. That's being looked at. No judge as of right now has shot it down to take a look. We'll see. But these tariffs are eventually going to go away, plain and simple. In the meantime, the deficits will not go away. The budget will expand, and they are going to bring in less tax take. And I don't benefit from it. But taxes will probably go up eventually. There will be a reckoning for this across the board. The US 10-year Treasury yield, 7.5%. If I were to travel in time and I saw 7.5%, I'd be like, yeah, totally. If we saw, say, 8.5% on the 10, well, you could see where we were at one point. Obviously, there was a big shift in the economy since then, but it gives you perspective that this is all possible. That we've actually been running on interest rate levels that are disproportionately too low anyway. We needed China to fund that debt. We no longer have China. The S&P 500. Now I just saw an interesting little blurb. What if the PE ratio drops as low below 20? We would see significant declines in the stock market. Here's the thing. If you increase interest rates by 1 full basis point, we're at 4, actually I think we're at 4.15, which is pretty low. There's a lot of people think that the Federal Reserve is going to be forced to lower interest rates. That's fine. What happens when funding, there's no one there bidding things up? That's the one thing that I kind of keep shifting to, that this is, it won't be all of a sudden, it'll be continuous. And then we'll start to see interest rates just climbing slightly. Frog in boiling water. Because of that, consumers in the United States of America are spending more and more on interest rates, which means consumption, by and large, declines. Revenues decline. I can't believe the S&P 500 is moving up as much as it is. I see it moving downward over a longer period of time. The US dollar index, likely to continue to slide lower because of all the shifting we've been seeing. Historically, well within reason. This shifts terms of trade. We simply don't make enough product here in the United States of America. Anything we purchase from abroad will be more expensive for 3 reasons. First, the dollar will likely decline, which means terms of trade decline. Second, interest rates move higher. So there's higher costs there. Third, tariffs. Effectively, we're being taxed individually across the board on all things. And we are going to have to finance more and more debt. Have you seen oil? Actually, as I mentioned earlier, I just got out of I was long SCO calls, which is the inverse ETF to, say, USO. They're not related, but I relate them. So USO ETF would be the oil ETF. We have seen oil moving downward because first OPEC Plus is like, we're just going to obliterate everybody. There's a lot of cheaters, and I think OPEC wants to tip their hat to the tariffs. So they just pushed prices as low as they could to punish a slew of individuals financially. Probably good news at the pump. I'll take it, always. Given that, I don't necessarily see oil dropping into the 40s, but it is very possible. Momentarily. And at that point, I would be buying oil left and right. But this gives you an idea that we're going to see some depreciation. Now, Chevron, all those other oil companies that are part of the S&P 500, the Dow, we will see these companies' stocks moving lower across the board because their product they work with is priced less, plain and simple. But this will be temporary. In the meantime, you got gold. China is shifting outward on the one hand. On the other hand, they're simply not going to be sitting on more new dollars. So I can actually see that gold could be getting to the point where it's tapping out on its big surge higher, simply because the Bank of China won't have those reserves because they don't have new dollars coming in. So this might be crossing the finish line. This is something I'm always kind of keeping an eye on lately because it's been surging as much as it has, especially over the past several years. This effectively becomes a brand new thesis. If anybody's sitting out there holding on to steady as you go, no, you wait. This is going to be so amazing. I wish you the absolute best. The reality is probably going to be quite different. And over the course of the month of May, June, and July, and August, the reality will hit. We will get jolts. of information. We will get continuous information. Then we'll get more jolts. Then we'll get more continuous information. I believe the stock market has printed its high. I believe interest rates are going to continuously move higher. And I believe economic activity will contract, and at the pace of growth, should we eventually get back up to positive, will be less. The S&P 500, the price to earnings ratio, I believe the 30s, gone. Plain and simple. And this is my thesis moving forward. And from now on, my content will be geared towards putting these pieces together. Make certain to follow along. We'll see you in the next video.